What's up, my real estate family? This is Norbert coming to you with another mortgage rate and bond update video. Man, it's good to be out of the dreadful months of October and November, which saw mortgage rates get beat up. You can see from this 30-year fixed rate chart the dramatic rise in rates that we had to live through in the past 2 months. Rates finally took a turn for the better the week of Thanksgiving, and thankfully, we are sustaining that momentum for the first week of December. Whew. Thank goodness. Week ending December the 6th, the conforming 30-year fixed rate mortgage was sitting at 6.68% according to Mortgage News Daily's rate index. This is with borrowers paying approximately 1% in discount points to get that rate. Your specific situation may differ, so make sure you get an accurate quote from a mortgage pro like me. So, what happened this past week? The big market mover was the November BLS Bureau of Labor Statistics jobs report, which was released on Friday. Let's break down the report. The report showed that there were 227,000 jobs created for the month of November versus the 214,000 jobs estimated by the markets. There was also a positive 56,000 jobs revision for the past 2 months. 24,000 added to the October number and 32,000 jobs added to the September number. Most of these jobs were rebound jobs. Now, typically these types of numbers would hurt mortgage rates, but bond markets were focused on the underlying weakness within the report instead. Traders knew that the positive revisions were caused by the extremely low numbers we saw in October, which were caused by the 2 main hurricanes and the 2 labor strikes, one being Boeing and the other was the International Longshoremen's Association strike. Instead, traders reacted to the unemployment rate going up 0.1% to 4.2%. What magnified the impact of this number was that it would have been even higher if it wasn't for the labor force shrinking by 193,000 people. This kept the unemployment rate lower than what it could have been. Now, you may be asking yourself, how is it possible for the labor force to shrink like that? Well, the way the Bureau of Labor Statistics calculates this number is by conducting a phone survey. They ask individuals a series of questions like, have you been looking for work over the past 4 weeks? Or have you submitted an application for employment or attended an interview in the past 4 weeks? If they answer no, they are no longer counted in the labor force or the unemployment ranks. Isn't that just wild? These individuals still do not have jobs, but are just magically no longer being counted. So you see, the unemployment number probably should have been higher, probably at 4.4% instead of the 4.2% which was reported. Investors are starting to catch on to this. This is the main reason why mortgage bonds did not have a big negative impact to the headline job creations number. Man, I hope this is making sense to you guys. It's really hard to explain some of this complicated economic stuff, especially in the short video format. So, what's on the schedule for next week? Well, the most impactful item is the CPI Consumer Price Index inflation report, which we get this Wednesday, December the 11th. This will be closely watched by bond traders as it measures inflation at the consumer level. Remember, lower inflation numbers equal lower mortgage interest rates for us and our customers. Make sure you tune into my next video to find out what the impact of the CPI report had on our rates. Thank you for watching this week's video. Don't forget to subscribe to my YouTube channel and follow me on Instagram. And until next time, let's get better, let's close more deals, and I'll see ya.